Our next guest, though, warns growth stocks are still too expensive. Joining me now, Post 9, Avery Sheffield, co-founder and CIO of VantageRock's. Good to see you again.
Great to be here.
So there are two, valuations have come down a little bit in those names.
A little bit. I don't know. It looks like a little blip. It was looking like maybe it was going to be more significant.
So you don't want to touch these stocks?
So look, I mean, it's a consistent theme whenever we've spoken. We're very valuation sensitive. We continue to be valuation sensitive. Okay. The market is not so valuation sensitive. And so, look, there continue to be mega cap tech stocks that we do like because they trade at very reasonable multiples relative to treasuries, relative to the short end of the curve, right? But there are a lot of other growth stocks, including some very popular ones, that are pricing in an enormous amount of growth. And that might materialize over time. But the more growth that you're pricing in, the more any slowdown can potentially create risks.
Okay, so Stephanie Link was on earlier. You referenced her talking about other areas of the market that you can do just fine in,
yes,
if you're willing to take a hard look rather than just jumping on this proverbial train, yes, that everybody is already crowded onto.
Exactly.
Like what?
Exactly. So
because you agree.
I absolutely agree. I agree that, like, you don't have to own the most popular names. Maybe they will work, right? But if you go to things that are unpopular, the nice thing is if things work, you get meaningful valuation expansion as well as earnings growth. And so a few areas that we have interest in. One, in retail, there were a lot of weak earnings reports,
yeah, I'll say,
in August, and you can get to a point where a stock is sold off enough that there's interesting upside in a potential turnaround scenario. Now, I'm not saying the macro is great, but if you look at what Fran, the CEO of Horowitz, the CEO of Abercrombie, has done with that company, right, and turned it around to like 8-10% operating margins, and you see other companies that are now trading at 2 to 3% operating margins that have potentially a reason to exist because they're selling maybe athletic shoes, which aren't going to go away. They're selling reasonably priced goods. They have new CEOs who, in the apparel sector, who have experience with turnarounds in the past. Say, there might be some opportunity here on normalized earnings. They're just cheap enough that the upside is 100% or more to these names over time.
Yeah, and this one you're specifically talking about A&F. That was one like right in that wheelhouse of those other reports that were dreadful.
Yes.
Right? And those stocks got crushed. And then this one was the real winner of that week.
Absolutely. And I think the lesson to be learned is retail is detail. And if you have the right product at the right price, merchandise well, over time, you can succeed even against a tough backdrop.
Okay.
And by the way, like years ago, not even that long ago, a year ago, people might have even wondered, is Abercrombie ever going to turn around, right? It didn't take that long for Fran to really put in place merchandising that made a real difference. And so I think a year from now, we could be seeing signs of that from other stocks. In the meantime, how do they drift? But I think you are seeing also the stock movement of some of the names that were beaten up the most, showing that maybe they're just too cheap on a potential normalized earnings scenario.
All right, so what about the market as a whole, right? We're ending August, and it's a tale of 2 months. First half, terrible. We're like, oh, my gosh, this is going to be a steeper correction. Where are we going to go back to?
Yes.
And then, lo and behold, we've had this rally back. So where does it leave us?
Right. So I think it leaves us at a pretty fragile point.